Hello everyone, good afternoon. Welcome to today's session. We'll be starting in a few minutes. Let's get started. Good afternoon, everyone. Welcome to today's session. Thank you for joining. Those who have joined on WebEx and those who are watching us on YouTube also. So today we have a very special guest with us. We have Mr. Neeraj Chadawar with us. He is our head of research, fundamental and quant, and we will be discussing our access topics for the month of September. So over to you, Neeraj, sir. Let's get started.
Yeah, thank you. And very good afternoon, everyone, for taking time out for our special session on Axis Topics Equity Investment Strategy for September 2024. So before begin, let me confirm, is my screen is visible? Aditya, could you please confirm?
Yes, your screen is visible.
Yes, thank you so much for the confirmation. Let's get begin. So we had released our topics report for the month of September a couple of days back with the title Near-Term Consolidation and Focus Remains on Style and Sector Rotation. Now we are glad to say that our Axis Topics basket has given an excellent return of 14% in last 3 months versus the Nifty 50 return of 12%. In last 1 month, this basket inch up by 2.7%. And since May 2020, this basket has delivered a return of 338% versus the Nifty return of 172%. means beating the benchmark by wide margins since May 2020, which brings confidence, and we continue to believe in our thematic approach for topic selection. So for today's webinar, first I will talk more about what has happened in the market, what are the key themes one would need to look at in the market, what is the outlook for 2024, what are the key monitorables for 2024, what is our Nifty target, what are our topics, and based on that, in next 10 to 15 minutes, I will take you through couple of charts which will be very interesting for the current market juncture. So starting with FY25 journey so far, so far it's a good start for FY25, but the volatile path ahead. We believe that macro will continue to be at center stage going forward. August first week was a very volatile month for the not only for the Indian equity market but for the global market, because we had seen yen carry trade unwinding. Due to that, the volatility spiked up, but later during the week we have seen some amount of coolness in the volatility, and based on that, recovery was seen across the globe including India. With this, for the month of August, Nifty 50 went up by almost 1.1%, and for other indices, that is broader market, also closed in green. In FY25 so far, FIs are the net buyer. They remain volatile for FY25 so far, but if I calculate the scale till now, they have invested almost $3 billion till now in FY25. On top of that, our DIs have invested almost 24 billion till now, which is of similar line they have invested in entire year. We have seen a solid run in the market in a short span of time. Now the question is that what lies ahead? We believe that based on the recent run-up, most of the narratives are already in priced. We see near-term consolidation in the market, and market style and sector rotation will be vigilant in the market going forward, as it was vigilant in last couple of months. And style and sector rotation will play the meaningful role for alpha generation going forward. We believe that at the current juncture, margin of safety in mid and small cap universe has reduced as compared to what it was available in the 6 months back. So based on that, market positioning is likely to shift towards large cap in the near term. So based on that, market positioning shifting towards large cap, more and more flows will be diverted towards large cap, and based on that, we believe that Nifty could touch new high in the upcoming quarters based on the allocation of phenomena shifting from broader market to large cap. We believe that at the current juncture, growth at a reasonable price and quality will be the overarching theme for generation alpha going forward. And based on that, the current market structure, we believe that private banks, telecom, consumption, IT, and pharma provide more margin of safety as compared to it is available in the domestic cyclical stock. We believe that this is a buy on dips market. We ask all our investors to maintain good liquidity, almost 10%, and based on and use any dips in phase manner to build position in high quality companies where the earnings visibility is there. We have made some changes in our topics recommendation, in which we book profit in CIE Automotive and Westlife Food, and we have replaced it with Prestige State and Sansera Engineering. So that is about our topics changes, which the key highlight for the month of September. Now going forward, what will be the outlook for the remaining part of 2024? What we believe that Indian economy continue to be a star performing economy in the global volatile market, and we believe that based on that, the Indian corporates continue to find space for demand momentum going forward. So outlook remains very solid for the economy, remains solid for the corporates. The corporates which are in demand of raising capital, they easily able to raise the capital in the market, which we believe that right now liquidity is very solid in the market, and in the near time soon we believe that that liquidity will be diverted towards the large cap universe. What are the key monitorables for 2024? Remaining part, the key monitorable will be the Fed meeting, which is scheduled the mid of September. So all eyes will be on the Fed meeting. The expectation is that one rate cut from the US Fed, or on a line of 25 bips of rate cut. We remain vigilant, and that will drive the further direction for the market. On top of that, now market is entering into the US election, which is scheduled in the first 10 days of November, and that will create more volatility in the global market. So that's why for the remaining part of 2024, we believe that volatility will be on a higher zone from the current level. We believe that right now the biggest challenge for the market is valuation. Valuation is no longer in a cheaper or in a very neutral zone. It is little bit expensive as compared to it is available in the past. So what we believe that the market return will be driven by earnings growth rather than the earnings multiple growth. So what we believe that going forward, earning growth will be the key driver for market performance going forward, and growth at a reasonable price and quality will be the overarching theme. We maintain our March 25 Nifty target, a base case target at 24,600, and we maintain our bull case target for March 25 at 27,000, in which we value Nifty at 22x. What we believe that at the current juncture, market, the likelihood of this scenario, a bull case scenario, is very high at the current juncture, and our bear case scenario, we maintain March 25 target at 19,700, and at the current juncture, the chances of bear case is very slim. Let's get to the month of September. You could see that it's a well diversified basket between large cap, mid cap, and small cap, as the market structure is shifting from broader market to more large and mid cap universe. So that's why we are having more recommendation towards large and mid cap universe, where we find more margin of safety at the current level. So out of 16 recommendation, 8 to 9 stocks are stands from large cap universe, and this basket has given almost 338% return since its inception in May 2020, which is well above 172% return given by Nifty 50 for the same period. Now coming down to what has happened at the India level. Now India is the 5th largest market in the world with a market cap of 5 trillion market cap. We believe that this 5 trillion market cap will play a meaningful role in the global context in upcoming year. It is very difficult for any FII investor to overlook Indian market when we have a 5 trillion of market cap. We are the 5th largest market in the world. So that brings confidence in the passive flow in the Indian equity market, with the continuity of passive flow going forward for upcoming years. Because we are the star performing economy, and our economy will continue to grow from the current level. And what we believe that will translate into the good earnings growth for the Indian corporates. Coming down to what has happened on a multi-asset scorecard, you could see that on a YTD basis, interestingly, the broader markets are the winner. Mid and small cap has given a solid return on a YTD basis, which has outperformed even the S&P 500, and that has outperformed the Nifty 50 universe. And what we say that EM index, that is the emerging market index, is continuously from last 4 to 5 years in the bottom 2 mark. That is the biggest reason for the driving of India versus other emerging market. So India is shining as compared to other emerging market, especially the China. So right now the chances of growth for Indian equity is very bright as compared to other emerging markets. So what has happened in last 1 month? From last couple of months, we are highlighting that the going forward volatility likely to increase and market positioning will shift toward defensive. The similar phenomena happened during the month of August. So in August, pharma, IT, FMCG, private banks has outperformed the domestic cyclical stocks like realty, auto, and metals. The similar phenomena likely to happen in the upcoming quarters also for the near term. Before we take again the overtake again take a overweight stance on the domestic cyclical, but for the near term we believe that market positioning likely to be defensive in nature. What has happened till now on a YTD basis? So that this defensive sector was on a backseat till 2 to 3 months back. In last 3 months, we have seen a good comeback of staples as FMCG, utilities, IT, insurance, and pharma companies. This trend likely to continue for the remaining part of next one quarter. Now, what has happened at a different themes level? Interestingly, the defensive stock has come back in the market, and the PSU stock taken a some pause in last month. We have seen a solid rally in the PSU stock. Now that rally, the money is shifting towards some other themes, and defensive are the winner at the current juncture. In terms of PSU as a market cap, so currently PSU as a market cap stands at 17% of the total market cap. What we believe that the long term average is 21%. In next 3 to 5 year, PSU has a capability to reach up to 20% of market cap as a percent of total market cap. What we believe that chances of reaching that 20% remains very high. Defense, PSU banks, OMC, utility, railway, all will be the next big leader. Now, for some time being, the momentum has paused in the PSU bucket, and that particular money is shifting slightly towards some defensive names. Now, what has happened on a 200 days moving average basis? So, currently, 81% of the stocks are trading above 200 days moving average. So, that indicates that majority of the stocks are trading near to that 52-week high, or remains around 5 to 20% correction from that 52-week high. Whenever we see this type of number, we see style and sector rotation, the evidence of style and sector rotation in the market. So this market is of rotation, the sector rotation, and that rotation is clearly visible in last couple of months. And going forward also, we believe that alpha generation opportunity lies in the sector rotation. In terms of retail turnover, so right now retail turnover stands at 55%, which is well above the long-term average. What we believe that this particular retail participation likely to continue in the upcoming quarters also. In terms of average daily turnover, we have crossed 87,000 crore of average daily turnover. What we believe that this is on the lower side as compared to last couple of months. So we believe that in the near term, based on the consolidation, this turnover will remain in the same range or some on a downside bias, and before we again market find comfort at a lower level. At this moment, the chances of consolidation in the near terms is very high. In terms of styles, so the growth theme has come back in the market in last 3 months after taking a backseat for a while, and the momentum has taken a pause. Momentum was the dominating theme for the market, not only on 1 month, 3 month, 6 month scale, but on a 1 year and 2 year scale also. Now momentum as a theme has taken a pause, and the other styles of the market are now taking the front seat, and based on that, growth is the leader has emerged in last 3 months. What we believe that at the current juncture, growth which is available at a reasonable price and quality will play a meaningful role for alpha generation going forward. In terms of national index versus international index, so if you see on 3 month scale, everything is green except media and metal, except metal and PSU banking index. What we believe that going forward, India has a potential to grow from the current level also, and all eyes will be on the sector and style rotation. It's a broad based rally what we have seen that, but now going forward, the expectation of the return for the remaining part will be on a lower side as compared to the magnitude what we have seen till now for FY25 so far. So what is very critical at the current juncture? So commodities are very critical at the current juncture. Currently, we have seen almost 23% rally in the gold prices till now in a 6-month basis. But in last 3 months, we have seen some amount of correction in the steel prices, aluminium prices, and the copper prices based on the muted data coming from the Chinese economy. We are not seeing any meaningful pickup in the Chinese economy, and that is why we are seeing correction in the metal prices. We remain vigilant on the development on the what data point which coming in the upcoming days. But right now the commodity prices are very on a corrective mode. In terms of Brent crude, it is also trading around $80 per barrel. Today it is went in last couple of days it went down to around 73 to $74 per barrel. So any further weakness in the crude, that will be positive for the Indian equity market. If we see a crude traded below $80 per barrel for a meaningful period of time, that will be very positive situation for the balance of payment for India in terms of India. So that will be the I would say this will be the monitorable commodity one need to monitor going forward, and that will drive the market direction going forward. In terms of India valuation index, so yes, currently we are trading in a higher zone. Our valuation is stands at more than one standard deviation as compared to the long-term average. This India valuation index is a combination of 12-month forward P price to book, bond equity earning yield ratio, and market cap to GDP. We believe that our indicators are suggesting cautious on market, book some profit. So that's why we are saying it's time to rotate the money from broader market to large cap and towards growth at a reasonable price and quality as a theme for the market. In terms of market cap to GDP, we are currently standing at 149% as compared to the long-term average. This 149% based on FY24 GDP. If I calculate the same number on FY25 projected GDP, we stands at 135%, which we believe that it's fairly valued market. In terms of valuations are little bit stretched. Currently we are trading at 21x, which and the long term average is almost around 16.2. We are trading at 1.7 standard deviation above the long term average. So current valuations are slightly above the long term average, which we believe that at the current juncture the re-rating opportunities is very limited. Market more driven by the earnings growth rather than the multiple expansion. In terms of relative valuation, so again on a relative basis as compared to emerging market, we are trading at 95% premium. What we believe that we continue to trade at a premium valuation as compared to the other emerging market, because we are the fastest growing market in the world. Even in the emerging market basket, currently Indian corporates are in a better shape as compared to it was in the pre-COVID world. The next thing is that the banking system is in a better shape. Next thing is that private capex cycle, which is around the corner. So all these factors are contributing for the premium valuation going forward. Now the risk for the market is that any dent in the earning deviation or the earnings growth. Any deviation in the earnings growth will be negative for the market. But at this juncture, what we believe that we likely to achieve the earnings growth going forward, because we forecast 16% earning growth for Nifty 50 starting from FY23 to FY26, which was only in 7% or in a single digit almost for a decade. This is the biggest driver, fundamental driver for the rally in the Indian equity market. After Q1 FY25 earning season, we have seen some amount of downgrades in the Nifty 50 earning. Now we forecast 9% growth for FY25 and 13% growth for FY26. What we believe that going forward, there is the likelihood of upgrades in the earning. One development which is happening at a Nifty level from month end onwards, September month end onwards, there is two replacement in the Nifty 50 index. Trent and Bharat Electronics are likely to enter into the Nifty 50. They are replacing Divi's Lab, and second is LTI Mindtree. Now the earnings of Trent and Bharat Electronics will again contribute at a Nifty 50 level, which we believe that this 9% growth has a fair chance to upgrade to 10 to 11% in FY25. And market is looking at those numbers, and what we believe that the chances of those upgrades are very, very high for the second half of FY25. In terms of profitability, currently we are sitting at 13.7 lakh crore of NSE 500 profitability, which we had never seen in the history of Indian corporates. Out of 11.7 lakh crore, 5 lakh is coming from the financial sector. And if I compare the entire profitability of pre-COVID world, that was again equivalent to 5 lakh crore. It means that NSE 500 total profitability in the pre-COVID world is on now contributed by only one sector, that is financial. That is the level of profit growth we have seen in last 4 to 5 years, and that brings the confidence in the private capex cycle in the upcoming year, which we believe that that will again drive the earnings growth for NSE 500 corporates going forward. And that is the fundamental reason we are not seeing any big corrections in the market. And based on this profitability trend, any correction which is coming from the global environment is the buying opportunity for next 12 to 18 months, keeping in a view. So what we believe that this is a buy on dips market because corporates are in a better shape. They are making good amount of ROE. Currently, ROEs are at a decadal high. Each and every sector is witnessing a improvement in ROE in last couple of years. And what we believe that this will drive the fundamentals of the market, and market multiple will sustain going forward unless we see some shocker coming from the global equity market. In terms of FIs, so FIs are back with a positive flow in last 3 months. So in last 3 months, they have come up with 7.2 billion of flows, and DIs have been invested 12 billion in last 3 months. In FY25 so far, 24 billion has already been invested by DIs so far, and 3 billion invested by FIs so far. What we believe that this flow will continue in the market. Even our SIP contribution has reached to 23,000 crore for the first time during the month of July. What we believe that these flows will continue to find support and continue to support the market whenever we see some amount of volatility uptick in the market. And at last, what is the risk on the market? So risk is currently the valuation. The second is the earnings growth. Any deviation in the earnings growth, which will be a risk for the market. And the third risk will be the macro risk. The risk will be coming from the global world. We are at the peak of the rate hike cycle. Now we are expecting the rate cut, which is probably starting from September meeting for the US Fed, and we remain vigilant, and that risk is very, very important to note in from the market. And any deviation in the US 10-year bond yield, which is opposite of the market expectation, we could see a near-term volatility in the market. So because Indian market is having 81% correlation as compared to US 10-year bond yields, so right now the risk is coming from the US market, and very soon we will enter into the US election, and that anyways will build the market volatility on a higher side. So for next couple of months, the direction of market is very, very solid, but the path will be very, very volatile, which is opposite of what we have seen in last 1 year. So that's why the we advise all our investors to remain invested in the market. Use any dips to build position in the companies where we have a earnings visibility, something like Axis Topics. This basket has delivered returns in last this basket is in live market from last 4 year, has seen all volatile phases of the market, and what we believe that one need to tap the volatility and invest at all levels with a view of next 12 to 18 months. So with this, I'm ending my presentation. Uh, Happy investing to all. Invest in our topics, and we will see once again next time, next month, with the update on October 2024. So with this, I am passing my call to the moderator. Over to you. Thank you so much.